Well, investors can't seem to make up their mind. The stock market, as of right now, is in the green, and it's in the green quite a bit. Yesterday, it was in the red. It was in the red a lot. Investors are trying to make up their mind about one piece of news. And the dreaded news is that there's cases of the Omicron variant being found right here in the US.
And the CDC have confirmed that a recent case of COVID-19 among an individual in California was caused by the Omicron variant.
Not again, not another variant we have to deal with. Regardless, because of the new variant, Biden has toughened testing for international travelers to slow down the Omicron from spreading within the US. But it's already here. We know how this works. You can't stop the virus from coming within the US. So we're going to hear news about new cases of the Omicron variant in every different state, even though it may not affect the economy at all. That's right, there's a good chance that the Omicron variant won't affect the US recovery at all. It won't have any effect. Tom Lee from Fundstrap points out that even the Delta variant, as bad as that one was, as lethal as it was, and as widespread as it was, didn't really slow down the US economic recovery.
I'm not a scientist, but there has not been a variant of COVID that has actually truly changed the direction of the economy. So I know this is very alarming, but investors need to take it in stride too.
If you think back over the past year, even with the Delta variant, the US economy has recovered pretty steadily. There's tons of demand, lots of jobs hiring, everybody that wants to work can work, companies are posting record earnings quarter after quarter, and that's all with a terrible variant of Delta going around right now. So I have to agree with Tom here. I don't know what could be so different about this new variant to completely change the reaction we had from the Delta variant. Tom actually goes on to highlight when it's a decent time to actually buy stocks.
Look, policymakers are panicking, and generally when policymakers panic, that's when investors want to actually step in.
The time to take your gains and sell, or at least hold, is when the coast is clear, when there's no panic in the air, when everybody is happy, when people are making money, when things are going good. That's a time when you should actually be taking gains off the table and selling. The time to buy is when things are unclear, when there's panic, when people are concerned. But the odd thing about this sell-off is that it's totally uneven, and it's actually being masked by the major indexes. For example, we can look at the S&P 500, and it's down 1.4% over the past 30 days, the past month. It's only down 1.5%. That's not really a big movement in a month. It really hasn't changed a whole lot. If you're investing in the S&P 500, right now you're not feeling like there's any big sell-off. Likewise, if you're investing in the Dow Jones, you're down 4.2% over the past 30 days. That's a little bit of a downturn, but not anything huge, not anything real concerning. If you're investing in the QQQ, you're completely flat over the past 30 days. So where is this major sell-off? It's not in SPY, it's not in the Dow Jones, and it's not in the QQQ. These major indices have masked the pain because of the enormous big tech companies that they hold. If you're investing outside of big tech right now, you're likely getting crushed. IGV, which only has one big tech company, which is Microsoft, is getting torn apart the past month. It's down 8.43%. This is a tech software ETF. So all those companies like Salesforce, Adobe, CrowdStrike, ServiceNow, all the different software companies you can think of are getting torn apart right now. WisdomTree's cloud computing ETF, which has 40 of the best cloud computing companies in the world, is down 15% in the past 30 days. Again, while the S&P 500 has barely budged. The ARK Innovation ETF is down 20% in the past 30 days, while the major indices haven't budged. And ARK's Next Gen Internet ETF is down 17.7%. Across the board, if you're outside of the major indices right now, you're getting crushed. If you are investing just in the QQQ, the Dow Jones, or the S&P 500, the top 5 companies are really masking the pain. These big blue chip companies are lifting up the entire indices. When there's panic in the air, investors go to the safe havens. And right now there is some panic. COVID-19 made Americans into super savers. Now they're hoarding cash. That means that people are scared. If they're hoarding cash, that means they don't have the confidence to go out and spend their money. So we have articles like this one today from the Wall Street Journal saying that people are being turned into savers. People are saving money and they are concerned. This is evident in the numbers. Over the past 2 years, households have socked away close to 1.6 trillion in excess savings. That's 1.6 trillion, not all together. That's not the total amount, that is excess savings. The funds are well beyond the 3 to 6 months of emergency savings generally recommended by financial advisors. So people are saving beyond 6 months. This is pretty incredible. Normally, it's tough to get Americans to save like 1 month of savings. We used to be a nation that proudly lived paycheck to paycheck, and we'd even carry a credit card balance on top of that. We liked living on the edge, but with everything that's happened over the past 2 years, the average person has become much more cautious. While the savings rate has dropped back to 2019 levels for 4 consecutive quarters of record high savings, financial advisors, money managers, and economists say that Americans are too nervous about potential worst-case scenarios to dip into those funds. And now with the Omicron variant of the coronavirus threatening to disrupt stability once again, many of them expect the cash hoarding to continue. So because of this new Omicron variant and the panic that it's caused, people may start saving yet again, even though across the board we already have record savings. Now maybe I'm just naive, or maybe I'm just a natural optimist. Either way, I'm not as concerned about this new variant. We've been dealing with a pretty deadly variant for over a year now, and the economy has still flourished. So I don't see how this can really change the game that much. In fact, some analysts are saying that this could actually speed up the recovery because this new variant is supposedly a little bit less lethal than Delta and it spreads faster, which overall could be a good thing. So JP Morgan strategists are saying to buy the dip as this may actually accelerate the pandemic's end. So let's go ahead and look at my portfolio and we can look at dips to buy right now. We can go through and see what's been selling off. In the 1 quarter view, we're down 0.6%. So in the past 90 days, the portfolio has traded down around 0.5%. That's not a huge move, it's pretty flat. But underneath this, there's a lot of changes actually happening. If we go down and look at the breakdown of my companies in the different categories, we can see that some of them are doing really well and some of them are having a lot of pain right now. In the tech and cloud computing category, I only have 2 companies, Apple and Microsoft. And right now we're looking not at all time, we're looking at just the past 90 days. So in the past 3 months, I've made 9.51% on Microsoft and 5.31% on Apple. Both of these are heavily in the green, and these big companies that make up such a huge portion of the QQQ and SPY, they're masking all the pain underneath. If we look at categories outside of big tech, in the past 90 days, Costco is up 16%. This company's on a massive roll right now. It really has a ton of momentum. In my opinion, Costco has traded up to an incredibly high valuation, but I think investors are paying a lot for a company that will do really well down the road. Regardless, I'm up 16% with Costco in the past 90 days. That's $3,500 overall. And then Disney's where we see the most pain. Disney's down 19%. Almost 20% in the past 90 days. Home Depot's doing excellent, Nike's doing okay. Comcast has also sold off over the past 3 months, and Target's pretty flat. Now, out of these companies that have really been dipping over the past 3 months, I'm not as interested in Comcast. This is one that I've considered exiting for a while now, but I'm not going to sell out of it when it's in a big dip. The company that I'm interested in is Disney. I think that this one has sold down too much. Disney right now is trading at $146, and it recently got as high as almost $200 a share. I fully believe that over time, Disney will get back up to $200 a share. I think this company is going to go higher than that. Right now, the company has a market cap of $268 billion. Netflix is a bigger company, and all the news of the new viruses and the new Delta variants and the Omicron variants, this has heavily and negatively impacted Disney. You can see the effect this is having on the company. It's for valid reasons. The earnings per share have been dramatically hit as the company has had to shut down a lot of their businesses and reduce the amount of people that they let into their parks. But Disney eventually will recover from this. I still believe that COVID is not going to be around forever. Eventually, there will be brighter days for Disney and all of their operations. In the meantime, investors were turned off because Disney Plus only added 2 million subscribers last quarter. But you have to keep this in context. They came out with almost no new content during this quarter, and they still added 2 million subscribers. Next quarter, they're coming out with a lot of content. They have new movies being added to Disney. They have the Boba Fett series. They have a lot of things that I think will attract millions of subscribers. As of right now, Disney Plus has 118 million subscribers. That is up 60% year over year. So they literally increased the amount by 60%, but investors are still concerned about the slowing subscriber growth. I've done a lot of research and work into the streaming category. I think the 3 big companies outside of big tech, Apple and Amazon, are Disney, Netflix, and HBO Max. I think the streaming services will consolidate into those 3 platforms. The other smaller ones that are popping up left and right are spending more money than they're making right now, and they can't continue that forever. Disney Plus has very good positioning, and I see it as one of the long-term winners. Now, we're still looking at the past 90 days here, and I see the other big categories that are in the red over the past 3 months. We have real estate. Real estate across the board, aside from one company, has been heavily in the red. We have Vici down 12%, Store Capital down 7%, Realty Income Corp down 5.5%, Simon Property up 15%. The quick summary with Simon Property is that this company got way oversold, and it proved far more resilient than investors had thought. Investors were predicting the demise of malls, and that really didn't happen. So Simon Property has made serious gains over the past year. Now, I think it's obvious why these are selling off. Vici in particular is selling off because it's an experiential real estate property. You have to go there in person, it has lots of conventions, and the longer that coronavirus or any variant drags on, the more pressure that Vici and their operators are under. On top of that, another thing pushing down Vici's price as of right now is that they have a lot of deals in transition and they're doing a lot of share dilution. So the share dilution puts a lot of downward pressure on the stock price. Both of these things aren't going to last forever. The panic over the variants isn't going to last forever, and the share dilution is not going to last forever. So in my opinion, even though the timeline has taken longer than expected, I'm still bullish on Vici overall. If you think that eventually we'll want to do conventions and do things in person, this company's going to be just fine. Vici's another company right now that I'm considering increasing my position in and lowering my cost average. Now, the last company that's seen a pretty big sell-off over the past 90 days, I think along with the rest of the panic, is in the restaurant category. Texas Roadhouse is trading at a reasonable valuation. It's a dividend payer with a growing dividend. And the big thing that I look for with this company that they've been very good at is growing their earnings. The earnings are growing over time. If you erase the initial effects of the lockdowns, this company has been doing fine. But investors get a little bit concerned when the government's freaking out again. So if there's not some big dramatic lockdown again, that this company will grow its earnings. And like Peter Lynch says, if the earnings grow over time, likely the stock price will follow. So the big thing that I'll be looking at with Texas Roadhouse is consistent and growing earnings. And if they do that in the future, I'm very confident the stock price will eventually follow. So even though my portfolio is down 0.25% over the past quarter, which is the past 90 days, that's really not a change at all. That's pretty flat. In my portfolio, there's still many companies that are down quite a bit, down 10% or more. There's Disney, Vici, and Texas Roadhouse. Those are three companies that I'm bullish over the long term, but in the short term, they've had major pullbacks. So I'll be doing buys into each of those three companies. You can do the same for your portfolio. Filter for the past 90 days, see which companies have traded down dramatically, and if you're still bullish on them. If the story long term hasn't changed, those might be companies you want to consider buying. But that's all for this episode. I hope you enjoyed the little update. If you like this type of content, make sure to subscribe to the channel. I'll have more episodes out week by week, showing you transparently my gains and losses and everything going on with this portfolio. So that's all for now. I'll see you next time.